Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day. It is Thursday, June 22nd. Quickly running out of another month here, headed into July quickly. Hopefully you have plans coming up for 4th of July weekend. Not this weekend, but next. We are going to cover a REIT out of the real estate sector today, Stag Industrial. Let's jump right into the video. If you want to know more about them, check them out, www.stagindustrial.com. That's www.stagindustrial.com. That is their homepage where I pulled this information from. Stag Industrial Inc., ticker STAG, again out of the real estate sector. Is a real estate investment trust focused on the acquisition and operation of industrial properties throughout the United States. By targeting this type of property, Stag has developed an investment strategy that helps investors find a powerful balance of income plus growth. So enterprise value, $8.7 billion. They have 111.6 million square feet. Number of states they occupy, 41, and number of buildings, 561, again in the industrial sector. So industrial buildings is what we're talking about here. And the reason we are taking a look at them, down 2.61%. We are talking about Stag Industrial, ticker STAG, again out of the real estate sector. Closed out the day at $34.67. Full disclosure, this was one I owned at one time. I felt it got a little, or based on the metrics, got a little overvalued compared to what I wanted to hold. And the growth is very slow. We will see that here in a little bit. So I opted for what I consider better opportunities on this one. Not a bad company, just I thought there were better opportunities at the time. 52-week range as low as $26.56, as high as $37.15. So they are closer to their 52-week high. I would definitely look for a pullback here if you were interested in this one. Average volume, 2.059 million. Today's was 2.1, so you can see that slide down throughout the day, pretty much a sell-off throughout the day. Market cap of $6.36 billion, a beta of 1.02, so they are just slightly, ever so slightly more volatile than the overall market. Price to earning ratio, $35.38 per share. That is high, but REITs, you really don't want to look at price to earnings. That's not a great metric. Funds from operation is a better one. Earnings per share, EPS, is pretty low on this, 98 cents. Not compare that to some of the other videos we've covered in the past. This is pretty low, right? 98 cents per share. So you are only making 98 cents on their earnings for every share that you own. That's not great. Earnings date, next one coming up July 25th through July 31st. Forward dividend is $1.47. Now, this is a monthly payer. That is one thing that some people like. If you were looking for a steady source of income, this would be a decent one to take a look at. There are others out there. Old Realty comes to mind. Maine is not a REIT, but it's one that pays out monthly. So there are other options out there, but this is one for a monthly payer. And it has a nice yield, 4.11%. Ex-dividend date was June 29th, coming up June 29th. So we've got a little bit of time. If you were to buy them now, you would be in line for the next dividend. And according to Yahoo Finance, they have an estimate of $36.95 per share on this one over the next year. So it speaks to some little bit of upside in the price appreciation here, but not a lot, right? It's right up against that target estimate. Now, let's go over, and if you go into statistics, you'll find under dividends and splits, I like to look at dividend yield theory. To do that, we look at the 5-year dividend average, 4.54. We compare it to the current 4.11, or what they call a forward over here, 4.11. And currently, the forward dividend yield is lower than the 5-year average. So this speaks to some overvaluation here, at least according to the dividend yield theory. So unfortunately, this one, even though it has a nice dividend payout, it is potentially overvalued, again, according to dividend yield theory. Payout ratio is elevated, 149.24%. One thing I'll remind you on REITs is they have to pay out at 90% or more of their dividend to maintain REIT status. Special tax implications there if they don't. So I'm not necessarily concerned when I see a company over this 100% like I would be for other companies because it's a REIT, but it is something to keep an eye on. If this continued for multiple quarters, then it would be concerning. Again, we looked at the ex-dividend date. Free cash flow, we want growing dividends over time, so we want the free cash flow to be growing as well. 2019 was $27 million. 2020, big jump up to $179. 2021, a little bit of a drop from $179 to $175. 2022, another big jump up from 21 to 22, $335. We haven't really got a read on what they're doing in 2023 yet, but overall from 2019 to 2022, there is definitely free cash flow here, growth. So that is nice to see. They're not really repurchasing stock. That is one thing about REITs. A lot of times they are actually issuing shares because their payout ratios are so high and they must pay out 90% or more. It is one of the ways they use to grow capital. So not a lot of REITs buy back shares. It looks like they did back in 2021. It is nice whenever they do. So whenever you see a REIT that does, maybe it's one to jump in and take a little bit more of a deep dive, because not a lot of them do. Like I said, a lot of times they're actually doing the opposite and issuing shares, just the nature of the company that, or the industry that they're in. Now, I always recommend more than one source. So another one that I like is stockanalysis.com. You pick out the sources that you want. Just make sure that you are looking at more than one source so you can back 2, 3, so you can back check the information you are getting is accurate. Now, according to the 7 stock analysts, they've had to take a look at this. They call it a consensus buy. Again, I don't necessarily agree with that because according to dividend yield theory, this one is potentially overvalued unless they see a significant amount of growth. But they have a low estimate of $34, which would be a 1.93% decrease. It's pretty much up against what their low estimate is. They have an average estimate of $38.43. That would be a 10.85% increase in the stock price. And if it happened to hit their high of $43, that would be a 24.03% increase in the stock price. All the while, you would collect that 4+% dividend yield. Now, this gives you a lot of the same information that Yahoo Finance does. Financials, you can get in there and take a look at their balance sheet, their income statement, right? And then statistics is another one I like to look at for return on equity and return on invested capital. I like 10% or better. As you can see here, it is lower than what I typically look for. ROE is at 5.2%. ROIC is at 3.0. So, numbers not great. Dividend yield theory says it's potentially overvalued. Just my opinion. This one I would probably look for more of a pullback, maybe back into the 20s. Under $30, 25, 26, 27. I might be interested in this one because, like I said, let's jump over and look at the dividend. Very slow growth on this one, 0.69. This was one of the deciding factors for me, really. 0.69% dividend growth. Even Verizon, which has a much higher dividend yield, that's part of the reason that I kind of got out of this one altogether. I don't mind slow growth. It is growing. 0.69% is slow, but it is growing at least. If it's really high dividend payout, like Verizon is only around 1%, a little over 1% growth, but they are paying a 7% dividend yield, right? I'm all right with 1% growth at 7%, not necessarily at 4%. It needs to be growing faster for me. Payout ratio, again, is elevated. You want to watch this over the next couple quarters, make sure it doesn't remain elevated. 90 to 100% is the sweet spot for REITs. Anytime they get elevated, they might be having some issues, but, again, not necessarily concerning right now. I would just watch it. And as you can see, they are a monthly payer: July, August, September, October, November, December, back again, January, February, March, April, May, June. So every month they pay out, currently paying out 12 cents and fractions of a penny there. And they do have that slow growth, like I said. So 12.12167, and they jumped it up in January, 0.1225. So not a lot of growth in this one in the dividend. Part of the reason, like I said, why I jumped out of them. I would not be interested in this company right now. I have Realty Income. I would prefer to dump money into that REIT than to add another one to my position. But Stag would be one to maybe throw on the watch list. And if it pulled back under the $30 range, like I said, into the mid, maybe even high 20s, 28, 27, somewhere in there, it might be worth a look if you're looking for something with a 4+% dividend yield. Even though it is slow dividend growth, you just have to take that into consideration. And like I said, it could be a good income play for you, though there are better options out there. Verizon comes to mind. Realty Income is another one, has a faster growth than this and still pays out every month. So other options out there, I would stay away from this one. Maybe throw it on the watch list. If it was to drop down significantly, then it might be worth it. But to me, this one is just a no-go. Just the way it goes. Sometimes not a bad company. I like the company, just not for me right now. This is my stock screener, right? You can run through this at your leisure if you'd like. And that is really it for this one. Let me know what you think of the video. Do you have Stag in your portfolio? If not, what other REITs do you own? Do you have some in the industrial sector like Stag or Realty Income's one that I own? Medical Properties Trust is another one. Omega Healthcare Investors is another one. I kind of like that healthcare space. I think Realty Income is probably the most popular, but I think Stag is pretty popular as well. So let me know down in the comment section if you own it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, trying to build a community of like-minded dividend growth investors so we can share our experiences, share stocks like this that we're watching, stocks that we have in our portfolio, stocks that we've sold out of because their fundamentals no longer meet our criteria or are looking bad. It's okay to share the things that you've done wrong in the past. I share whenever I do something wrong. We are not perfect. We're human beings. Everyone's going to make mistakes. Even the greatest investors in the world, like Warren Buffett, make mistakes over time. Don't let that be a deterrent to investing. The only way to financial freedom is to invest in yourself. Make sure you're putting that money away. I prefer dividend growth stocks. Some people like growth stocks in general, or some people like just buying real estate or stocking money away in a high yielding savings account. Whatever it is, you got to be putting that money away so that you can spend it later in life and eventually get out of the rat race. That is the idea behind this channel. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company that you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. Should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek advice counsel by a certified financial advisor.